So this stock option trading course would actually help the beginners to understand right from the basic and the fundamentals of options. What are these options called? Why are they called options? How many type of options are there? And how to trade them? There are different strategies, right? Just like stocks, you buy and sell stocks. The same way you can buy and sell options as well of the same stocks and underlying. So today I will explain the basics and fundamentals of stock options. Okay. Now this is going to be a step-by-step guide. Right now we are talking about the foundation level. So let's start. So first of all, what are stock options or what are index options? So basically the basic idea remains the same for options. The underlying could be stock, the underlying could be index. Okay. So stock options is nothing but a contract, basically an agreement that gives you the right but not the obligation, which means that you have the complete right to actually use it, but there is not a requirement or there is not a compulsion that you have to use it. And what is that right? Basically, if you have the stock option, you can either buy or sell that stock at that price before the expiration of that option. Now, each option comes with an expiration date. Unlike stocks, once you buy the stock, you can keep it for your lifetime as long as you want. Wherein, when you have the option that has the expiration date, majorly for stocks, we have monthly expiration. Okay, that is till now the last Thursday of every month. Same ways, we have options for the index as well. But index has the expiration monthly as well as weekly. The day remains the same, that is Thursday of every week is the weekly expiry for index options, and last Thursday of the month is the monthly expiration of the index option. When we talk about index option, basically index just like Nifty, Nifty 50, mid cap Nifty, Fin Nifty. Now, these are all the indexes. Each index has the expiration which is different. For example, Nifty has the expiration on every Thursday. That is the weekly expiration. The last Thursday of the month is the monthly expiration. Same ways, we have mid-cap Nifty that has a different day of the expiration. I hope you understand this so far. Now, what are these options? Option is basically a choice. Okay, you can also say it in the type of options. So first is when you feel that the stock option can actually go up or it can grow in future. So basic idea is the call option. Call option actually helps you to exercise your contract if the stock price rises in the future. Same ways, we have put option that is denoted as PE and call option is denoted by CE. Now, put option gives you the right to exercise the contract if the stock price falls. That means if in future you're expecting the stock price to go down, you can actually buy the put option. We will talk about it in detail that how these options work and when to buy which option. Okay. I hope till now you are clear. I'll summarize once again. Stock option is basically an agreement, is basically a contract that gives you the liberty to either buy or sell that stock till that expiration date. Okay. Now, call options are generally bought for long perspective. If you really feel that the stock can go up, you buy call option. If you feel that stock can fall to a certain price, you buy the put option. Same ways, you can also sell these options. Okay. Let's talk about the next slide, where we will try to understand why trade options when you already have stocks. Why do you even need options? You can simply go and buy stocks. Why do you even need the stock options? So first is potential for high returns with less capital. For example, let's say if you have a certain company, I'll here take an example of Reliance. Now Reliance stock might cost you 1000 rupees. And now if you want to buy 100 stocks, you would have to at least spend 1 lakh rupees, wherein you might not have that kind of capital. And you still feel that Reliance stock can go up in 1 year or 1 month. Okay. Now, here is the thing. You can actually buy Reliance stock option. As we discussed in the earlier slide, that for long, that means if you feel that the stock can go up in the price or in future, you can buy call option. Now, to buy a call option, that is basically a bundle. Okay, you do not buy a custom quantity. Each stock option is basically a contract of specific number of units of that stock. For example, Reliance stock option is basically called a lot. Every stock, every index, options or futures are actually determined in the number of lots. Each lot has specific quantities. For example, Nifty has a quantity of 75 per lot. Now that means every lot of Nifty index, Nifty 50 index would have 75 quantities. Same ways, for example, Reliance stock. Reliance stock might have 100 quantities in one lot. This is not the accurate size, but I'm just telling you to understand. So one lot is the minimum quantity to trade in options. You can go in multiple lots as well. So one lot might have 100 quantities of Reliance stock. That means 1000 stock wherein you were buying 100 quantities, you were spending 1000 into 100, 1 lakh rupees. Now you feel the price can go from 1000 to 1100. So you don't have to buy 100 stocks. Where instead of that, you can simply buy one lot of Reliance stock options, which is equivalent to 100 quantities. Now, you just need to pay the amount, the price. Basically the stock option is 1000 rupees, but the option price for 1100 strike might be of, let's say, just 100 rupees. So 100 rupees of one quantity of option into 100, that is the quantity of per lot, that makes it 10,000, wherein you were just buying 10 sorry, wherein you were just buying 100 quantities of Reliance stock and it was costing you 1 lakh. Now you're just buying 100 quantities of option for the same stock. Now you just have to pay 1/10 of that cost. So this is the first reason why people like to trade in options instead of stock. Now, flexibility to profit in any market condition if it goes up, down, sideways. Now, this needs a very deep understanding because options can actually help you make money in all these three directions, wherein stock might have a limited, direction. So let's say if you're, bullish on that stock, you will make money only when it goes up. But what if it falls down? So the same ways, we can say that options give you the flexibility to make money in either direction. We will talk about it. How is it used? Okay. It is also used to hedge existing investments. Now, you have Reliance stock. Again, we'll just talk about it. You have 100 quantities of that stock already. You've already spent 1 lakh rupees by purchasing Reliance 100 quantities at the rate of 1000 rupees. Now you feel that in the next 1 month it can go down to 900 rupees. That would be a loss straight for 10,000 rupees, right? So instead of that, what we can do is, as we discussed in the last slide, that if you feel the stock can go down, you can buy a put that is denoted by PE. Okay. That means the way we were just buying a call of 1100 when we were bullish on it, now we can buy put of 900 rupees strike. Again, we might not have to pay the whole amount. We just have to pay a fraction of the amount, that is around, let's say, 100 rupees. Okay, 100 rupees per quantity. That means 100 rupees into 100 quantity. That is the lot size. That makes it 10,000 rupees. You just buy that put one lot, and yeah, you have hedged your Reliance stock portfolio. That means now if it goes down to 900 or below 900, you are hedged. You will not incur any losses beyond 10,000 rupees, even if it falls down to 700 rupees, which is 30% less than your buy price. That is 300 rupees per stock. And if you have 100 quantities of that stock, that would make it 30,000 loss, right? But now if you have bought the put of 900 strike for, let's say, 100 rupees, your maximum loss is capped to 10,000 rupees. This is called hedging. We will talk about it in later videos, do not worry. I'll explain how they are used step by step. I'll tell you, how they can help you to make money, how they can help you to hedge your portfolio. Yeah. Now, it can also help you to generate some extra income. That is, one way of it, and that strategy is called covered calls. But again, as we are talking about the foundation level, we will discuss this in detail in upcoming videos. So even if you have a portfolio, the way you just hedged your portfolio, if it falls below 900, the same ways if you have a portfolio, it can also help you to generate some rental income by selling calls. So options can be bought, options can be sold as well. Okay, so we'll talk about it. Let's move on to the next slide. As I told you, call options, that is denoted by CE. When are they used? When you believe a stock is bullish and it can go up in near future, you will simply buy a call. Now, for every speculation, you have to pay a premium. Okay, it's very simple. Let's say if you have an insurance policy, okay, and you speculate that in near future or in next 1 month or 1 year, right? I'll just take an example of your car insurance. Okay, that would be safer than your life. So if you buy a car, right, now you feel that in once you start driving on roads, it can cause accident to others, or others can cause some damage to your car. You buy an insurance. Now for insurance, just for this speculation, right, you have to pay some premium. Let's say 10,000 rupees for 1 year, right? And that gives you, the IDV insured declared value of 10 lakh rupees. That means up to 10 lakh rupees that company would now cover your damages. And what you pay, just 10,000 rupees for that. Now there could be a possibility there is no damage at all for complete 1 year. Now this premium is gone again. So this insurance policy or this agreement came with an expiration date, right? That is 1 year. Same goes with call. Now you have an assumption that the stock will go up. And let's say we'll talk about the example. You have ABC stock, okay, and now you have that stock for, let's say, 400 rupees you purchased, okay, and now you feel that the stock can actually go to 500. Okay, now what you do, you simply, so the options work with strike wise. Strike is nothing but the different price level of the stocks. So you feel that this stock ABC can actually go up to 500 rupees. So you simply go into the market, you buy a call option of 500 rupees strike. This is the level of stock, in different prices levels. So now if this ABC stock goes beyond 500, let's say 600 rupees, okay, you will make a profit. How? You must have paid some premium for this. For example, let's say 10 rupees, right? Because you're assuming it will go till 500. But for this assumption, you are signing a contract for 10 rupees. 10 rupees is basically the premium, right? And let's say a lot is for 100 quantities, right? That means 1,000 rupees you paid for this assumption, assuming this agreement that it will go up to 500. But now your luck worked and this stock rose to 600 rupees. Now you said 500, it rose to 600. That means it has gone 100 rupees above your strike, right? And this 100 rupees above your strike is your total profit. Okay, that means 100 rupees is the per stock quantity price profit, and 100 rupee is the total quantity in a lot. No, sorry, not the 100 rupees, 100 quantities in a lot. So 100 into 100, you got 10,000 rupees of profit, wherein as a premium you just paid 1,000 rupees, that is 10 per quantity for 100 quantities in a lot, right? So that's how you just made a lot of money. But just in case, instead of 500, it slides down to 300. 400 was your average price. Now it slides down to 300 rupees. That means 100 rupees loss, right? Now this 100 rupees loss plus the premium that you paid 10 rupees per quantity is also gone. Okay, this is how call option works. Now the same ways we have put option, that is denoted by PE. As we discussed, when do you buy PE? When you believe the stock can go down. It's in a bear phase, right? It is bearish. And again, when you are assuming that I have a stock and it can actually go till 400, right, or 300, whatever level. So you just bought a 500 rupees strike. It can go to 500. Let's say this time you had this stock for 600 rupees you had purchased, and now you feel that it can go till 500 rupees. So what you will do is you will buy a put, okay, of 500 rupees strike. Now your luck worked again. Instead of 500, it went down till 400 rupees. So your buy price was 600. You bought the put assuming that it can go till 500, but instead it went till 400. That means from 600 to 400 straight. Okay, but you bought the put of 500. That means 100 rupees extra move, right? You will pocket in these extra 100 rupees. That is beyond your strike price. Again, 100 rupees profit per quantity and 100 quantities per lot. That is total 10,000 rupees of profit. Again, you must have paid a premium for this. Let's say 10 rupees again. That is 10 rupees per quantity, 100 quantities per lot, 1,000 rupees you paid for this agreement. That, I feel this is basically an assumption, right? So you said that I feel that it can go down to 500 from 600, but it went down to 400. That means from 500 strike that you actually purchased, from there till 400, the difference is 100 rupees. You'll pocket in this premium. Now, there are certain strategies. Now, options, this is the basic understanding of options. But here are different strategies, how these options are traded. You cannot simply just go and buy, the options. There is some strategy. If you'll do it without understanding the same ways you just go and buy stocks, you understand something about the company first, right? You analyze, you research, then you conclude whether to buy it or not. Same ways is the option. Every option has some strategy. Why to buy it, when to buy it, right? And how to buy it. That is called, like, you have to even hedge your options. Just like your portfolio, when you have stocks holding, you hedge them by buying put. Just in case if these stocks go down in price, the puts would protect you. Same ways, if you have bought some, options like calls or put, you hedge them as well. So this entire process is called a strategy. So there are some popular strategy. I'll just talk about, the three basic strategies. First is covered call, as I told you in the previous slide. There is a way that you can actually generate some rental income from your portfolio. If you already have some stock holdings, you can actually generate some monthly income on that. That is hold stock plus sell call option. As we discussed, Reliance, you have at a rate of 1,000 rupees, you have 100 quantities already, you have 1 lakh worth of stocks in your portfolio. Now what you can do, you can actually sell it. It's just the same with the just previous slide. You feel that the stock can go up to 1,100 rupees. That means 100 rupees above your buy price, right? Then there would be a premium. For example, 10 rupees per quantity, and the lot size is 100 quantity per lot. That means you are assuming 100 rupees move. For that, you are paying 10 rupees per quantity, 100 quantity per lot, that is 1,000 rupees. You are actually paying. What if somebody else wants to buy this? You can even sell this 1,000 rupees agreement, right? So that person will pay you 1,000 rupees for this agreement that, if this stock goes to 1,100 rupees, you would give me all these stocks, right? So this is just an agreement. So this is called covered call. You are covered. If you already have stocks, if they move up, you have collected 1,000 rupees already, and if they go till 1,100, you will give all those stocks to that person. This is called covered call. Now there is something called protective put, hold stock and buy put option to protect your downside. As we discussed, if you already have Reliance stocks in your holding, same price from 1,000, if you feel that this can go down to 900 rupees, so you simply buy a put of, let's say, 900 rupees, that in case if it goes beyond 900, let's say 700, 600, you are protected. That is called protective put. The put would actually pay you. The more the difference from your strike, let's say if you bought 900 rupees put and the stock moved to 800 from 1000, that means your strike was 900. From your 900, it has moved 100 rupees beyond your strike till 800. That means this extra 100 rupees would be paid back to you, okay, from this agreement. That means 100 rupees per quantity, 100 quantities per lot. That means 10,000 would be paid to you. Now, no matter, even if it goes till 500 rupees till 200 rupees, right? That means from 900 rupees strike till 200, there is a difference of 700. Now this 700 would be paid back to you as per that agreement. As we discussed in the first slide, It's basically a contract. Okay, so this contract would be paying you back the difference from your strike. Okay, now another thing is called cash secured put. This is basically a contract wherein you do not hold the stocks, but you agree to buy at that price. For example, Reliance is trading at 1000 rupees today, but you say, I will buy it only at 900 rupees. So you're not buying them at 1000 rupees, but you want to buy it at 900 rupees. So if we are assuming the stock price would go down, we buy put, right? In this case, we will actually talk about 900 rupees put, but instead of buying, we are selling it, because when you sell the option, you actually will buy the stocks in this case. So put option, when put option is sold, you are agreeing to buy stocks. When call option is sold, you are agreeing to sell your stocks. Okay, this is how you have to understand. So cash secured put is nothing but you are selling a put option contract for that strike price, let's say 900, that if the price fall beyond 900 rupees, I am ready to buy this stock, basically the lot of 100 quantities. That is called cash secured put. You have enough cash to buy the stock if this price falls beyond 900 rupees. Now, there are certain risks, right? If it was this easy, if it was this simple, everybody would have started, just trading options. Why would they go for stocks, right? So, you have to understand one thing. In case if you have bought the option, be it call or put, and if your assumption has gone wrong, for example, you have the stock of 1000 rupees or not. Let's say if you feel the Reliance can go up to 1100 rupees, you pay 10 rupees premium. And if it does not reach 1100, it expires at 1050 rupees. That means your assumption was wrong. Your speculation was wrong. Now the entire premium is gone because you earn, as we discussed, you earn when the price crosses beyond your strike price. Okay, very simple. Same like with your insurance. You assume that in next 1 year, if there is any damage, the insurance company would pay you back the amount for the damages. That's why you pay the premium. But in case if there was no damage, no accident, by God grace, of course, the whole premium is worthless now, right? You lose that. Now, prices influenced by volatility, time decay, like that theta and market moves. So volatility basically is the fluctuation, okay? The size of fluctuation. At times, the stocks are not that volatile. So the prices of the options would also not be inflated. For example, I'll tell you this way, okay? If you feel that, there is some property, okay? Now, there is some property in some area, everything is fine, right? The one customer said that I am ready to buy this for 10 lakh. Another one said that I am ready to buy this for 11 lakh. The owner is asking for 12 lakh. Very simple, right? Now what happens if there is a change in government, right? And government says that the road in front of this property has to be widened. Now what happens? This will cause a lot of volatility in the prices, the assumption, the speculation. Some would say, the half part of this property would be gone. Some would say the entire property would be demolished. So based on these fear factor, okay, now people would not know what is the right price, what should we be paying for this property, or the owner would also be very scared, right? Now he would say instead of 12 lakh, he would say that I'm ready to sell this off for 9 lakh rupees. The fear factor increases, volatility increases. Now you see from 12 lakh he was expecting, now he's asking for 9 lakh, and somebody would say I'm ready to buy this at 6 lakh. So there's a lot of fluctuation. The fluctuation that was just 1 lakh rupees, like somebody was paying 10 lakh, somebody was paying 11 lakh, he was expecting 12 lakh. So the size of that fluctuation, of that difference or expectation, was just 1 lakh, but suddenly this has increased to 3 lakh rupees. So the owner is ready to sell from 12 lakh to 9 lakh, but the other customers who were ready to pay, even 10 or 11 lakh, now they are paying just 6 lakh. So the difference from 1 lakh came to 6 to 9, 3 lakh. This is called volatility. So if there is the increase in volatility, the prices can also increase of options basically. And if the volatility decreases, the same goes with the option prices, they also decrease. So till the time you do not understand, do not jump in for the options trade. Time decay, theta, basically the expiration, as I told you, every option contract comes with an expiration date. So always, beware that theta basically loses value with time. So as the time passes, the value of the option decreases automatically, irrespective of the stock price movement. And the market moves. The overall sentiment of the stock market, let's say if people are scared, then obviously again the market would be really volatile. The stock prices and the option prices would fluctuate a lot. Now, another thing is start with small position and clear risk management. If you do not really understand the risk, you do not really understand a lot about stock market or options trading, and if you really want to jump in, I would suggest you start with very small positions. First, check and test, whether do you even understand, or you are mentally prepared or not. Okay. First of all, I would not even suggest you to get into options trading if you do not even understand that. Now, there are some terms that you must be aware of if you really want to understand options trading. First is the strike price. As I told you, these prices are the different price levels of the stock. Okay. If a stock is right now trading at 1000 rupees, there would be a strike price in the multiples. It could be in a multiple of 10, 20, 50, 100, anything. So, for example, 1000 rupees is the stock price. Now, you would have some strike prices like 1100, 1200, 1300, 1400, 1500. Same ways in the downward side, let's say 900, 800, 700. So, these are the different price levels which are called strike prices for which you are buying the contract or selling the contract. Another is expiration date. As I told you, every option contract comes with an expiration date of validity till which date it would be valid. Then the premium, as I told you, the way you pay for your insurances, you the same way you pay the premium for the option contract as well for your assumptions. If they are right, you would be paid more than your premium. If you're wrong, you would even lose the premium. Now, intrinsic versus extrinsic value, guys, this is little, in detail have to be discussed, but right now I'm just telling you how to decide, whether the option is actually cheaper or expensive. That is basically decided by intrinsic and extrinsic value. If I tell you, the basic idea is the intrinsic value is the residual value. You can say, if you have bought a car, right? So today you are getting a car for 1 lakh rupees. Just an example. Just assume Tata Nano. You are getting this used car or any car for 1 lakh rupees, and now you want to understand whether it is expensive or cheap. So you would see the general idea, is how much is the scrap value of this car. Let's say if I'm going to scrap this car, this would actually give me 25,000 to 30,000 rupees, and I am paying 1 lakh. That means 70,000. Of course, this is not how the valuations work, because there is some brand value as well. There are a lot of other things are also into that car. It is not decided, but I'm just telling you what is the intrinsic and extrinsic value is broadly what is it. So 30,000 rupees is the intrinsic value of this piece, right? The metal piece. Now you are paying 70,000 rupees extra for what? You're paying it for the brand value, you're paying it for the comfort, you're paying it for the features, or the other accessories that car has. Same as in the options. Options have some intrinsic value. What is the real value? Okay. And the extrinsic value is basically the factors that we discussed: the time, the theta, the volatility, right? How much is it fluctuating? So all these are the other features, the comfort, everything. So you are paying for that. But if today I am going to sell this car to scrap, forget about anything. How much is it going to give me? That is called the intrinsic value. Now, there would be a lot of people who feel that, we understand the options, we can simply trade in it. We don't mind. I have 1,000 rupees stock of Reliance, and I can simply go ahead and, sell the 1100 call, and I'll do the covered call. Or I do not even have any holding. I can straight away go and, buy an option for 1100 rupees of Reliance. If it crosses 1100, I'll simply make the money. Why do I even need to have the stock holding? Guys, there are a lot of technicals. Okay, basically what we call is option Greeks. Okay, you have to understand, because if you buy blindly without even understanding anything, you would not be aware of the time decay that option is going to have. You would feel that if it will cross 1100, you'll make money, but you have to understand, even if it crosses that level, you would not make money if you do not understand the options for the time decay. Because let's say, I'm just giving you an example, if you just paid 10 rupees premium for 1100 rupees strike call for Reliance, what if it goes till 1110 rupees? Are you going to make any money? Your call should be worth 10 rupees, because you bought 1100 strike and it has crossed your strike by 10 rupees. So of course your call is now in the money by 10 rupees, but you already paid that 10 rupees as a premium. Would you make any money? No. This is just one of the example. If you are going to use leverage without understanding, there is a lot of people say that, we'll just take some kind of leverage, we'll take some margin facility, or we'll just, take some loan and we'll just do it. We can easily make money. Instead of buying 100 quantities of Reliance stock, I can simply buy one lot of call just by paying 10 rupees premium per quantity. That is like 10 into 100 quantities per lot, 1000 rupees. It's very simple, right? You would feel that, I can buy 10 lot or 100 lot, I do not even have need to. Do not do this. Do not. Okay. Chasing quick profit instead of learning strategies. I'm sure you guys are really very excited that, we already understand stock market, we already understand options trading. We can just try our hands. Don't do that, guys. See, trust me, I have seen a lot of people, and I have also made these mistakes without even understanding anything. Do not even do it, because there are a lot of people who say that, driving a car is very easy. You just have to get onto the seat, you just have to turn the car on, shift the gears, and accelerate, and yeah. But the problem is, do you even know which gear to, shift in, right? Or how much pressure do you have to put on the pedal? No, you have no idea about these things. These looks very simple, right? But there are a lot of technicalities. Do not skip on that. Over trading without a clear plan. Guys, there are a lot of people who simply feel that, if they have made a loss, they would recover it by over trading, or in the next trade. I mean, instead of one lot, now they would put in two lot, three lot, 10 lot. Do not do this. This is called over trading, and this kills a lot of traders. Don't do that. Now you would feel that, how do I get started? I really want to try this. So first, instead of putting the real money, go for demo account first. There are a lot of companies who provide you some demo accounts. They give you some demo money, which is not the real, and you can just try placing some orders and see how you're performing if you really understand options trading. And also try to understand the margin facility and option Greeks, as I told you, delta, theta, vega. There are a lot of things, right? You have to understand those first. Again, do not try to chase profits, guys. Do not. First understand and learn, and then try to make money. Okay. And also first try to observe the stock market. How does it move? You know, what is called bear move, what is called bullish move, what happens, if the volatility increases, right? And then practice with your dummy accounts, with your demo accounts, with the paper trade. Try to practice first and check your learnings, whatever you have learned, whether the understanding is correct or not, whether it is working out in the market or not. Okay. Now, there are some tips if you really want to, just go ahead and want to trade. Put some stop loss. Do not trade without a stop loss, because that can actually kill your bank accounts. That can even put you in a lot of debt. Stop loss is basically, whenever you are trading with some kind of money, you have to define your loss, that how much loss you are ready to bear, not beyond that. Never invest your money that you cannot afford to lose. It's very simple, guys. If you have limited money, if you just have 10,000 rupees, do not put that at stake. If that 10,000 is gone, you would be left with nothing. Okay. Always have spare money. If you have 10 lakhs, and if you feel that, if I can lose 10,000 rupees, that won't matter a lot, go for it. Try your hands. And keep a trading journal to track your learnings, track your mistakes, what went wrong, track your failures, because a lot of people just trade, and if they fail, they just, try to change the strategy, but they never analyze. They never go back and analyze what went wrong. When you took a trade, you would have some kind of logic behind it, right? It didn't go your way, right? try to analyze what went wrong, because the trade wasn't wrong. You are the same person who took that trade. If it did not go in your direction, what went wrong? Try to analyze and then go for the next trade prepared, and by making some improvement and tweaking. Always continuous learning. Till the time you'll keep on learning, you'll keep on growing. The chances of being successful would be high. But if you stop learning, as I told you, keep a journal to track your mistakes and failures. If you don't do that, you'll hardly be successful in, at least in a trading career. I'm sure you would have a lot of question and answers, and you would want to know more than this, because this was just a basic overview, a foundation, right? So don't worry, this is just the first video. We would be talking about a lot more than this in detail. So I would expect you to put your questions in the comment section. I'll pick them up and I'll actually prepare for your question in the next video, and I'll try to cover them in detail, in-depth understanding. And if you have any kind of specific question related to stock or options trading or futures trading, do let me know. Comment in the comment section, and I'll definitely try to pick that up for you in the next video. I just wish you all the best. And guys, I just want to clarify that I am not a SEBI research analyst. Okay, none of this slide or the content recommends you to pick any stock or buy any stock. Okay, these are just my learnings, my understanding, and my observations that I'm trying to share with the upcoming traders who are in the making. So this might help them. Okay, thank you and all the best. Bye.